a lot to talk about. Let's focus on India first. We'll broaden it out to the rest of the world. There's an absolutely stunning rally taking place in India for equity markets, more than doubling since the depths of the pandemic, March 2020 or thereabouts. Seeing a few jitters now, but give us a sense of whether there is momentum there and whether there's an appetite, given a few companies have decided to look, the valuations are looking rather rich.
Yeah, I think it's really important. First of all, good morning to all of you. And great to be here. Thanks for having me. Obviously, you referenced March 2020. And if we could all go back to March 2020 and predict what was going to happen, the reality is very few of us predicted the actual outcomes we're experiencing. Now, I think the good news in India and in other parts of the world is that economically, you're certainly starting to see continued momentum and support from local governments to ensure that countries emerge strongly from the pandemic. Having said that, it's our view when you look at it from a bottom-up perspective, looking at individual equity prices, that a lot of the recovery and a lot of the good news in the future has already been priced into the market. So I'm not one to ever say markets are over undervalued or call it top or bottom, but what I can say is that when I look at returns in the future for India and candidly for other parts of the world, it's highly unlikely that the returns of the past 18 months are going to be what we're going to experience in the next 18 months. They may not be down, but I don't think they're going to come anywhere near kind of matching what we've experienced.
And we certainly have seen a structural change in the India equity market after 2 pandemic years, where you are seeing more retail individual investors now making up of half of cash trading volumes. You see when it comes to flows in mutual funds as well, quite robust. Do you see it as quite a significant shift, and how supportive is that to the market?
Well, first of all, I think it's a good thing when more people become involved in their local markets, right? I think like sometimes there's a misnomer. People assume that retail money is dumb money, and that's just not true. Investors around the world have increasingly shown that they're informed, that they come to the table with valuable insights and can collectively have an impact on the markets, and they're taking control of their financial future. So I think that that's a good thing. Of course, from a behavioral perspective, and I'm a University of Chicago person, so from a behavioral perspective, the thing that's concerning is people tend to chase performance. And I think if investors, and I think there's probably a cohort of them in India as well, who are just chasing performance and have come in after the good returns, I think there's a danger those folks will be disappointed. And so the key here is really for people to have the right expectations and be sure that even if we do go through a leaner period, they remain participants. Because the key, even in markets like India, is really the money you can make over long-term periods being an investor, as opposed to what you're going to experience over short-term periods. And sometimes people get overexcited or overwhelmed by what happens in short-term periods, and it really doesn't matter in the long-term cycle of what it means to be an investor. And so I think it's a good sign for India and other places that more retail investors are getting involved. It's just the time horizon, I think, is maybe something that some will have to adjust to over time.
Kunal, further on Yvonne's point there about retail investors coming in, also going into these mutual funds. What about the mutual funds themselves? It's probably been great to be passive, but does next year mark a move more towards active?
It's the $1 million question. I think like the way I would describe it is we get really hung up on whether it's active or passive. I think the debate on mutual funds is really about expenses. And Morningstar's research has shown that whether you're buying active funds or whether you're buying passive funds, the driver tends to be your fees. And so all I would say is there are plenty of successful active strategies, and there will remain plenty of successful active strategies. They're just the low-cost active strategies, and there's plenty of good ones that fit the bill. So I think if you're a long-term investor...
Come on, Kunal. Kunal, you're dodging the question. Come on.
I'm not dodging the question. I think it's the reality. You can build a great portfolio, but predicting an annual outcome is just not the way most investors should look at it. You should be in the market for 3, 5, 10 years, and using expenses as your guide for part of this is very, very important.
ESG obviously is a big focus globally, and even in India, they're talking about how there's a number of big conglomerates. They're looking to go green and curb their carbon emissions, but the regulator also talking for that, but then also warning about greenwashing as well. How do you look into this issue, Kunal?
Yeah, I think it's probably one of the most major issues, and it's not just in India, it's happening around the world. You see in China, it's becoming more of a dominant issue. I think it's a good thing overall, because fundamentally what ESG has the potential to do, you referenced earlier, all the folks who are becoming investors. And one of the things that is worth thinking about is like what sustains people's interest in investing. Because markets will go up and down over time. And historically, we've seen that when markets go down, people's interest tends to fall a little bit. I think ESG is going to change that because it personalizes the way people think about investing, and it attaches them to their investments in a way that perhaps has not been the case in the past. So it's still early days in places like India and in Asia in general, but I think the potential is real. And it's true that there's a lot of greenwashing taking place, but beyond that, there's also a rising demand from investors for clearer information, standardization, more transparency, and firms like Morningstar are doing even more to just bring more data and accountability to what's being published. And we're introducing ratings and risk measures on the ESG front, for instance. And I think these things have the potential to transform the long-term ability of ESG to have staying power. And I think truly, if you're long-term investors, this is a great way to engage with your investments and build your portfolios. And the data is only going to get better. And so I think there's a lot to look forward to in that context.
So Kunal, we talk a lot about evidence that ESG funds or ESG funds which have a high rating, you have your own ratings naturally, of course, for ESG, that they do better than, less ESG orientated companies, let's say, or funds even. What have you found when you've drilled into the data on performance?
Yeah, it's certainly been the case that if you look over the last 5 years, even going back the last 10 years, although the data set is not quite as robust, that performance of funds that have had ESG-linked strategies has been better than the broader market. And one could say that part of the reason that that has happened is that they have had a growth-oriented tilt to them. They've had higher exposure to sectors like technology, which tend to score better on ESG metrics than, say, the energy industry, which until recently has had a pretty poor decade in terms of shareholder returns. And so certainly from that perspective, returns have been better. Now, the question is what happens going forward? And I think the key thing is really starting to think about how ESG can continue to sustain that. And I think you do that by really trying to pick strategies that you think have the power to succeed in the future. So for example, if you believe we're transitioning to a green carbon economy in many parts of the world, including in India, China, and other parts of Asia, what are the companies best positioned to benefit from that, as opposed to the old way of looking, which is exclusion, and what was basically avoidance of those strategies, or companies that were going to feel the brunt of that strategy. So I think the new word is inclusion, and what do you include in a portfolio that can help you, benefit from the view that you have.
And Kunal, I just want to, before we let you go, I know it's getting late in Chicago, but just your overall outlook for 2022. I mean, these last 2 years, I guess, has been just the last couple of months even, just been volatile as seems like this whole, Omicron variant and COVID is just going to be a big overhang for markets here. We also have the prospect of tighter liquidity as well. How are you looking at next year, and what does this mean for the business?
Yeah, I'm going to disappoint you with my answer because what I'm going to say is the most important thing for everyone is to stay the course. It's really important, regardless of where you are, to just have a strategy and to stick to it, because at the end of the day, it's hard to predict markets over short-term periods. And I think you want to have a portfolio that is positioned for long-term success and that's right for you. And I think if you do that, it's not really going to matter what happens in 2021 or 2022. What matters is what happens over the next 3 to 5 years. And I think from that perspective, most folks should be in a good spot.